Capital gains taxes explained. What triggers them and how to lower what you owe. As millions of Americans prepare for tax season, one topic continues to generate confusion and concern: capital gains taxes. These taxes apply when individuals sell assets, ranging from stocks to homes to collectibles, for more than they originally paid. While the concept sounds simple, the rules governing gains, losses, and reporting requirements are anything but. Understanding capital assets and gains. In tax terms, nearly anything a person owns can be considered a capital asset. That includes personal items such as cars and furniture, as well as investments like stocks, bonds, and real estate. When an asset is sold, the difference between the purchase price and the sale price becomes either a capital gain or a capital loss. A capital gains tax is levied on the profit from that sale. The amount owed depends on several factors, including how long the asset was held and the taxpayer's income level. Short-term versus long-term gains. The IRS classifies capital gains in two distinct categories. Short-term gains apply to assets held for 1 year or less, while long-term gains apply to assets held for more than a year. The distinction matters. Long-term gains are taxed at preferential rates of 0%, 15%, or 20% depending on income. Short-term gains, however, are taxed as ordinary income, meaning rates can climb as high as 37%. Tax experts say this difference creates a strong incentive for investors to hold assets for at least a year. You're likely to owe less in taxes when you hold an asset for the long term, analysts frequently note. So, how to know when taxes are owed? Taxpayers owe capital gains tax only when they have a net capital gain. This is calculated by subtracting total short-term losses from total long-term gains. For example, someone with $15,000 in long-term gains and $5,000 in short-term losses would owe tax on the remaining $10,000. The importance of adjusted basis. Determining the correct tax bill depends heavily on calculating an asset's adjusted basis, or the amount originally paid plus certain fees or adjustments. This figure becomes especially important when assets are gifted or inherited. Garrett Watson, Director of Policy Analysis at the Tax Foundation, warns that misreporting basis is a common and costly error. Neglecting to factor in cost basis or misreporting it could overstate tax liability or, in some cases, understate it, he said. Getting these details right with thorough documentation is important. Capital losses can offer relief. Not all investment outcomes are profitable. When losses exceed gains, taxpayers can deduct up to $3,000 of net losses from their income. Larger losses can be carried forward to future tax years. Here is how to report gains and losses. Reporting capital gains requires navigating several IRS forms. Form 8949 is used to list each asset sold, along with its purchase date, sale date, basis, and gain or loss. Schedule D summarizes total short-term and long-term gains and losses. Brokerages issue Form 1099-B for investment sales, while real estate transactions generate Form 1099-S. These documents are also sent to the IRS, making accurate reporting essential. Strategies to reduce capital gains taxes. Financial planners point to several legal strategies that can help taxpayers reduce their capital gains burden. The first strategy is to hold assets longer. Because long-term gains are taxed at lower rates, delaying a sale can significantly reduce taxes. The second strategy is to use tax-advantaged accounts. Retirement accounts such as 401k and IRA allow investments to grow tax-deferred or tax-free. Tax associated with short-term gains and dividends are deferred until withdrawals occur in traditional accounts, Watson explained. The third strategy is to take advantage of home sale exclusions. Homeowners who live in their property for at least 2 of the past 5 years may exclude up to $250,000 in gains, or $500,000 for married couples filing jointly. Lastly, the fourth strategy is to consider tax loss harvesting. This strategy involves selling investments at a loss to offset gains elsewhere. While potentially valuable, it comes with strict rules and is best done with professional guidance. Professional guidance recommended. Given the complexity of capital gains rules, many taxpayers turn to professionals for help. Watson notes that experts can assist with determining accurate basis, understanding inheritance rules such as the step-up in basis, and identifying opportunities for tax savings. As tax season approaches, understanding how capital gains work and how to manage them remains essential for anyone who buys, sells, or invests in assets. The final thoughts. Capital gains taxes remain one of the more complex areas of the U.S. tax code, touching everyone from casual investors to homeowners to retirees drawing down their portfolios. While the rules can be intricate, the underlying message is clear. Understanding how gains, losses, and holding periods work can significantly influence a taxpayer's bottom line. With markets fluctuating and more Americans investing than ever before, the ability to navigate these rules has become increasingly important. For many, careful planning and, when necessary, professional guidance can make the difference between an unexpected tax bill and a well-managed financial strategy. Please comment below on your thoughts. I'd love to hear your perspective.